Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So follow the series till the end. Also, watch the complete series. Share it with your friends, all your friends. Like it. Then write in the, if you like it, write in the comment section. Okay. So let's start. First one. The market the market risk arises on account of the transactions reflected in means what is this? Firstly, market risk here. If you have followed the complete series of mine, if you are following this regularly, then you'll understand you'll be in a link with this. Okay, where I've explained many times these points over here: market risk, credit risk, ops risk, systemic risk, other things as well. So the market risk arises on account of the transactions reflected in banking book, trading book, banking and trading book, banking book, trading book, and off balance sheet exposures. So what do you think should be the answer? It arises because of what? Market risk arises because of. Think, everyone think. In the meantime, I'll give you the meaning of market risk. Here, there are three risks basically. Mainly, I'm not saying three risks. There are many risks, but mainly in Basel we consider three risks. Basel 2. Okay. One is credit, second is market, and third is ops, right? And third one is ops. So credit risk arises because of what? See this, credit risk is also further two types. Counterparty means your party to whom you have sold or you are the loan borrower might be the default person, might default on his own, right? Or second is country risk. Country, okay, the country in which you have given sold the material might be the bad country, means Afghanistan or North Korea, something like that, right? Second is market risk. Market risk arises due to external events. Remember this. Always, market risk is not in your hands. It relates to the external events. Means Russia-Ukraine war or China invades this Taiwan tomorrow. That's the external thing. COVID, okay, which is not in your hands. Ops is in your hands. See here. Now, ops can be many reasons as such. One of them is the employee wrong inputting. Second, there are others as well. Even flood is a ops risk. Flood, famine, dacoity, terrorist attack, all these are ops risks. Okay. So this market risk arises in the transaction because in which type of transaction? Again, what are these questions? Look at this. Banking book, trading book. What is this? Banking book, trading book. Type in the comment section. Okay, those who are watching or following the classes regularly, type in the comment section. This banking book versus trading book. Okay, I'll ask you the question. The CRR purchase, the bonds which are purchased, T-bills we call it, T-bills which we purchase for CRR or SLR are in which book? Banking book or trading book? Type in the comment section. The bonds which we purchase for CRR or SLR are in which book? They are in banking book, right? Banking. So what is the basic rule of banking book? In banking book, remember, the bonds which are purchased are kept till maturity. Till maturity. Okay? They are not sold in between. But there is a separate book called as trading book. In trading book, whatever you purchase, it is called as a proprietary book. Proprietary. Proprietary means what? Here the books are, here the bonds are purchased for selling, for profit. These are called as for sale. Securities for sale. Okay, these are securities for maturity. Okay, so these are proprietary bonds. Okay, these proprietary bonds are sold whenever the market price is high. Okay, now you tell me these are for selling. Now you tell me if you have a flat, okay, if you have a house or flat, whatever you say. If you have a house or flat in which you are staying, you are not going to sell it. So whether this market price is high or low, will it affect that flat? No. because you are not going to sell it. So that's why banking book bonds are not affected by this market risk. Market risk either makes the prices, takes the prices up or down, right? So banking book is a basic kept until maturity. So that's why market risk won't affect them. But trading book, yes. If I'm going to sell some bonds and at that time the price collapses, then I'm at risk. So the market risk on account of transactions is reflected in only trading book. Many of you have typed this off balance sheet item D. See here, we have a habit in our questions or in our life, or basically JIB, CIB, I'll call it specifically. Whenever we see all the options, yes, all of the above or all the options given, we try to tick on that. It's not compulsory. Remember that all the options which are given might be correct. All of the above is correct. Nothing like that. Okay. Off balance sheet item is totally different. Off balance sheet item has nothing to do with the market risk. What is off balance sheet item? Off balance sheet is LC, bank guarantee. These are all off balance sheet item. What has it to do with this market risk? It is a fixed contract. Market risk arises when you don't have a fixed contract. It depends on the external situations. Okay. So too long for this question. So the answer is B. Next one. A trading book consists of bank's proprietary positions here. Now, importantly, remember this first question which I took over here. Okay. In this question, I've given you all the details. Now the further questions will be easier for you. A trading book consists of bank's proprietary positions in financial instruments covering debt securities, equity, foreign exchange, and commodities and derivatives. So, trading book consists of what? Does it consist of debt securities, equity, foreign exchange, or commodities, or does it include derivatives? 1 to 5 all, 1 to 4, 1 and 2, 1 and 3. Look at the options. Yeah. Tell me. Now again, many of you have gone into that this line which I have told you. All of the above is not correct always, but sometimes it is correct. So here it is all of the above. 1 to 5 all. Debt, equity, forex, commodities, derivatives, anything which is related to market whose price goes up or down as per the market conditions is included in trading book. Keep it very simple. Okay. Clear? Okay with this? Type yes in the comment section if you have understood it. Type yes. Move on. Chalo, next one. The trading book of a bank is exposed to following types of risk. Trading book, again look at this. Trading book is exposed to what? Market risk, liquidity risk, credit and counterparty risk. So trading book means what? Trading means which is affected by the market risk. So it is affected from what? 1 and 1 means only one. Means only one. I'll just write it over here. One only. So 1 to 4 all. 1 to 4 or 3? Is it 4? No, 1 to 3. Okay. So 1 to 2. Let's take this. 1 to 2 only. Okay. 1 to 2. 1 to 3. 1 and 3. Then 2 and 4. And only 1. So what is the answer? Yeah. Yeah. Now this is something difficult for many of you. Okay. The answer over here is, see this. Market, liquidity and credit and counterparty. So market, liquidity and credit and counterparty. So all of them can be affecting this your bonds. Okay. All of them. Why? Because the problem is, see this. Market risk already I have explained you. Liquidity means what? The liquidity is of two types. Liquidity risk. Okay. Liquidity risk is of two types. What are the two types? One is asset liquidity. Asset. Again, join the paid classes. In paid classes, I have given in details over here. asset liquidity, and second is this market liquidity. Market liquidity, okay. So basically these are the two types of liquidity. So both of them will be affecting the trading book. Let it be asset liquidity or market liquidity. Basically your prices will go down. It's that simple. Credit and counterparty risk, that is also there, because the what is this, what do we have in this trading book? We have the debts, we have the equities. Suppose if the issuer of that bond, issuer of that security, shares, issuer of that any coin, this coin or anything. So suppose if a Bitcoin somebody is having it. So if the issuer of that security, if that security, the issuer goes down or becomes bankrupt, then you have a credit risk. So the answer is all of them. Which is the option? All of them. 1, 2 and 3. Okay, so let me make it over here. 1, 2 and 3. The answer is 1, 2, 3 all. Okay, so the answer is A. 1, 2, 3 all. Okay, got it? Chalo. Next one. Liquidity risk in the trading book consists of asset liquidity, market liquidity, funding liquidity. So liquidity risk in the trading book consists of what? Think over it. Let's do it fast now. Okay. All of them, asset liquidity, market liquidity, funding liquidity. Again a trap, right? Again a trap. Many of you feel that funding liquidity is also liquidity risk. Funding liquidity means I don't have funds, right? I don't have funds with me, okay, with my bank. Understand the difference over here. Understand the main difference over here. Okay, firstly, let me give you the answer. The answer is B, 1 and 2 only. No funding liquidity. Now you'll ask me why? Why no funding liquidity? Because look at this, funding liquidity means what? Here, there are two factors, external and second is internal. Okay, I'll write it over here, internal. Okay, the two liquidity risk which I gave you, asset first, right, and second one was market. Market. These are all external factors. Asset liquidity and market liquidity, both are external factors. What about internal? In internal, if you see internal liquidity, the problem I'll tell you, it is due to my internal problems. Internal problems means my bank is not having sufficient funds, I have not managed my asset liability properly, ALM, asset liability management. I have not done this ALM properly. So that is my internal. So that doesn't become the part of this in trading book. That is not the part in the trading book. That is my internal problem. Trading book is always dependent on the external factors. Got it? So that's why the answer is 1 and 2 only. Clarity, very clear. Okay. The ability to freely transact. Okay. Ability to freely transact in the markets at a reasonable price is called. Now this is fast. Market liquidity, trading liquidity, market making and market movement. Yeah, freely in the markets. Okay, the confusion is between A and B, market liquidity and trading liquidity. So I'll give you the correct answer directly. Let me see in the comment section first. Yeah, trading, that is the right answer. Trading liquidity. Okay, the right answer is trading liquidity. Market liquidity means what? It is not the not in your hands. Here again, external and internal. Okay, ability to transact freely transact in the market. So if I'm having that much money cash with me, this is the internal factor. If I'm having that much cash with me, I've managed my ALM properly, asset liability management properly, then I'm having trading liquidity. Market liquidity means what? It's not related to you. It's related to the entire bank, this financial space. Okay, if all the parties in the market are not having the funds, like in COVID situation, COVID was a huge problem, specifically for that 1 month, March 2020, specifically for that month, there was a huge problem, right? So market liquidity relates to that. And here, when I'm speaking of this freely transact, it means it's a trading liquidity. This market liquidity will be a part of your this what trading book. Okay, got it? And trading liquidity will be the part of your internal sources of funds. Okay. What risk arises from lack of liquidity, trading liquidity? Trading liquidity means again your internal problem. Funding liquidity risk, asset liquidity risk, liquidation risk, market liquidity risk. What risk arises from this? Majorly it is all of them are there. Okay, funding liquidity, asset liquidity, liquidation, market liquidity. See here, market liquidity can't be affected by your trading liquidity because this is your internal. Just now I told you this is your internal, this is your external. Is Bank of India's funds or financial position dependent on SBI's position? Or is Citibank's position dependent on SBI's position? No. This is external, this is internal, this is your own ALM management, right? What about others? Funding liquidity risk. Funding liquidity means risk means what? Funding liquidity. Asset liquidity. This okay. Let me explain asset liquidity. Asset liquidity means what? Trading liquidity. This is a basically a type of credit risk. Somewhere we relate to there because asset is not getting liquidated. It means there's a problem in that asset, that bond. Okay, so asset liquidity, I told you there are two types of liquidities. One is asset, second is market, right? So asset means specifically to that asset there's some problem, right? So what is the answer then? Funding or liquidation then? It is basically liquidation. What is liquidation risk? Liquidation risk is another way, it is called as bankruptcy. A company has gone into bankruptcy means company has gone into liquidation. It means that. Okay. So liquidation risk is a major risk due to which this due to this trading liquidity. Have you seen anything? I'll give you a simple example. How many of you know this SVB bank? SVB. Okay, it's not this Indian bank I'm talking of. It's a foreign bank, USA. Silicon Valley Bank. Silicon Valley Bank went into bankruptcy. Bankruptcy, right? In 22. Yeah. Okay. I'll just write bankruptcy. Okay. So this bank went into bankruptcy to this 22. Why? Because of this trading liquidity. It had invested the money which it had received. See this. The money which it had received means what? Basically, what does the bank do? It takes deposits. Right? Deposits we take. And then we invest it in these deposits. They go to the bank, and then bank invests them in what? It invests them in either loans or bonds, right? So what did this SVB bank do? Silicon Valley Bank, Silicon Valley Bank. What did this bank do? The deposits were of short-term deposits. I mean they were from CASA, current account, savings account. And where did this bank invest? They invested in bonds of 30 years. Do you think it's right? Short-term deposits which I have received, I have invested in 30 years bonds. Where is the liquidity? This will give me the problem in trading liquidity. Okay, so that bank faced this major problem. Got it, everyone? Chalo, next one. A particular corporate security has been facing the lack of trading liquidity. This is called as, so trading liquidity is faced. Okay, this is called as funding liquidity, asset liquidity risk, all of them. Funding liquidity risk, asset liquidity risk, asset liquidation risk, and market liquidation risk. Lack of trading liquidity. Yeah. It is called as again liquidation. Just now I explained you this whole Ramayana, right? Liquidation, liquidation. So this same question, similar question, liquidation risk. Okay. So this is asset liquidation risk. Liquidation means going into bankruptcy. If any bond is not getting sold, then that company has a fair chance of going into liquidation or bankruptcy. Okay, this is very important. This is the only reason why this SVB bank or Silicon Valley Bank, okay, it went into default. Okay, got it? Next one. There is a general liquidity crunch in the market and it is affecting the trading liquidity adversely. So crunch, financial crunch is there and it is affecting my trading liquidity, my ALM also. So it is called as what? Funding liquidity risk, asset liquidity risk, asset liquidation risk, and market liquidation risk. Correct? Market, in the market. So obviously the answer is when such simple questions come, you should answer it directly. Market liquidation risk. The credit risk of a traded debt security such as bonds, debentures, commercial papers is indicated by credit risk. Remember, how is it indicated? Earnings from these securities, face value of these securities, credit rating of these securities, and all of the above. How do you tell any company is good or bad? Will you buy that bond or not? Triple A, double B, triple B, what all is that? The answer is this simple. These are obvious questions, right? Credit rating. Hi friends, welcome to the Scholar series of BFM. Here we are covering important theory questions, objective questions, and some numericals. So let's start without wasting the time. We'll be doing the objective questions. I'll be asking you the questions and explaining you as well. Not only I'll just ask you or give you the answers here. Answers are not that important. Explanation is important. Answers you can definitely get it in the books also, right? Which of the following foreign exchange operations have been useful in treasury management operations? Which of the following foreign exchange operations? So which of them foreign exchange operations have been useful in treasury management? Arbitrage, swaps, A and B both, and none of these. Now I'll tell you one thing. Firstly, give me the answer. Then I'll give you where are the loopholes. Type the answer. Is it capital A? Let's mark only this. A, B, C or D. What is the answer? Many of you have answered this C correctly. C is the answer. Right? But before going ahead to the next question, C is the answer, agreed. Have you understood what is arbitrage? Have you understood what is swaps? If you have not understood it and you are just typing, you have heard some word about arbitrage, you have heard some word about swaps, and you are saying, yeah, in treasury they are used. So I'll take both A and B. No, no, no. Don't do that. In BFM, you need to understand the things. That's important. Okay. What is arbitrage? Arbitrage means buying from one market and selling it to another immediately. For example, I'll give you a simple example. We see that sabji wala, vegetable vendor, vegetables. The one who comes on the road near our house. Sabji le lo, bhaji le lo, right? That Nana Patekar. Nana Patekar, you remember in that movie, No Entry? Aloo le lo, what gobi le lo, that sabji wala. What does that guy do? That guy does this arbitrage. What does he do? He buys it from the dealer. Dealer means distributor. Dealer. And immediately same day sells it to the retailer, means retail customers, to us. Let's call us only customers. Okay. So what does this distributor do? He buys it from this dealer and sells it to the customer on the same day. Okay. So today, if we today morning, generally this vegetable market is in the morning between 4 to 7 a.m. in the morning. Okay. There the whole wholesale market works, and after 7 a.m. this retail market works. So this guy buys it over here from the market on the same day, day one. Let's say D1 only, day one.
and this guy sells it to the customers on the day one only. See here, vegetables can't remain for the next day. These are perishable items. Tomorrow, if somebody comes to sell you today's vegetables, immediately one can recognize that these are old or stale vegetables. So that's why this guy has to purchase only that amount which he can sell today. So that is arbitrage. Buying in one market and selling it into the other end, earning the commission on this. Similarly, in BSE and NSE also. Suppose if there is a Reliance share, okay, I buy it on NSE at let's say 2500, and immediately I sell it on BSE. Suppose there is a gap, price gap between these two exchanges for let's say this happens hardly for 4 seconds. 4 seconds. So there is a gap of 2500 over here and it is 2503. 3 rupees gap is there. So what will I do? I'll buy 1 lakh shares over here and sell 1 lakh shares over here. So what have I done? I want 3 lakh. 1 lakh into 3. 3 lakh. In how many seconds? 4 seconds. That is arbitrage. Safest. Okay. Swap means what? Swap is different. In swap, always remember, I'll just give you one basic over here for swap now. In swap, always there is one leg which is fixed. One leg that is fixed and other leg that is floating. Okay, floating. One leg is fixed, other leg is floating. For example, if I take 1 lakh rupees from you, 1 lakh, okay, and I guarantee you 7% rate of interest. So this is what fixed. I am guaranteeing you 7%. Okay, so this is going out. This is minus, right? For me, it is out. So I am guaranteeing you 7% rate of interest. So this is fixed. And what do I do with this 1 lakh rupees? I invest it, let's say, in the stock market. Stocks. Now these stocks can give me, either they can give me 50% returns also, right? Or they can give me 0% returns also, or minus also, minus 50% also. Anything can happen. So this is floating. So in swaps, always remember one leg is fixed and other leg is floating. Okay. So that's why the answer is both A and B, and these both the operations are used in forex as well as in the treasury bonds also. Risk in trading securities may arise from the following. So trading in securities may arise from what? Now this is a very simple answer. Trading in securities may arise due to what? Number one, foreign exchange transactions. Second, equity holding. Third, lending and repos, and all of these. So trading securities may arise because of what? This forex. Definitely, if the rate of the dollar goes up or down, definitely that will affect it. Equity holding. How much equity I am holding? Equity holding means what? Suppose if I am holding the shares of, let's say, Infosys, Reliance, TCS, all these companies, so that is my equity holding. So if it goes up, share market goes up, stock market goes up, I'm benefiting. If down, I'm losing. Lending and repos. This is basically related to bonds. Remember, lending and repos mean, repos are the, what do you mean by repo? Everyone. What is a repo? Repo is the rate at which RBI lends to the banks, right? RBI gives money to the banks at repo. Hmm? Remember, this repo is traded in the market. Traded. You'll say, how can it be traded in the markets? Here, repo is what? RBI has given you money at this rate. Okay. So if tomorrow, after 6 months, or let's say after 3 months, the repo rate decreases, then it will be this, the rate at which it was given earlier is at higher rate. Let's say it is, let's say 5%, example I'm giving you. After 3 months, it becomes, let's say 4%. So the one who is holding the 5% repo will be at an advantage. So that's why it is traded. So here, trading is done wherever there is a gap in the interest rates. Trading is done everywhere. So the answer is all of these over here. Okay. Which of the following is not an agency service of the bank? Agency service. Agency means what? Here the bank is acting as an agent. Agent means what? LIC agent. Remember this? LIC agent, insurance, or any other agent also, means mutual fund agent. What does the agent get? Agent gets only commission. Same thing, bank also gets only commission in agency services. So which of them is not the agency services? Extending credit, escrow. merchant banking services and insurance selling. So which of them is not the agency? Not, they are not acting as the agents. Now very easy one but tricky one. You can immediately see the answer. Let me see how many of you can answer over here. Correct. Extending credit. It is not an agency commission over here. It is the core business of the bank. What is the business of the bank? Basic business of the bank, right? Deposits and loans. So extending credit is a basic business. Escrow, merchant banking services, insurance, and these are all agency services. Okay. Escrow will take a lot of time. Otherwise, I would have explained you. Escrow is actually, I'll just give you one liner. Escrow is a temporary account. When two parties don't trust each other and they have some funds in common or something in common. This is generally done in road contracts by large companies, or even two buyers and sellers in different countries. If they don't want LCs, okay, they don't want the cost of LCs, so they use this escrow account. Temporary accounts, yeah, the funds are kept in the bank account, right? And it can be taken by, means it can be withdrawn by the sign of both. Okay, it's like a joint account. Okay, so escrow account is that. Merchant banking services, again one liner only. Merchant banking means basically whenever you have that IPO, right? Reliance IPO, TCS IPO, all these IPOs. There the services are given by the bank as merchant banker. And insurance selling, you know. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever we require, you get it over here. So that's why download it right now. Okay. And don't just download it. Start studying also. Otherwise, how many apps do you have in your mobile? How many apps do you have in your mobile? Can you even tell me the number of apps? Not possible. My second question, how many apps have you actually used in last 1 week? How many apps have you actually used in last 1 week? I'll tell you. WhatsApp, right? WhatsApp is the app you have used. Some banking app you might be dealing with, any bank, right? If you are dealing in shares, then this is this app of this DP, right? Then what? Nothing else. That's it. And some YouTube and all these things. So that's okay. So we don't use the apps that much. We just download them and keep it for some time, and that sometime never comes. Same thing should not happen with this app. Download it and start using it on a daily basis. Okay. What is off balance sheet risk? Off balance sheet, which is outside the balance sheet. Off balance sheet. Okay, it is contingent in nature. Means contingent means what? It is not for present, but it may come in future. It can occur on account of issue of guarantees. So guarantees is what? Again contingent, come in future, right? Bank's commitment may happen on account of failure to meet the payment obligation. That can also be possible. Means when I issue the guarantee, what does it mean? I'm telling somebody, if this guy doesn't work, I will pay you, whatever your losses are. So actually, if this guy doesn't work, then what? I'll have to pay it. So that's why it may get converted into cash, and this is known as crystallization. Crystallization means crystallization means converting the contingent liability into real liability, means cash flow liability. So the answer is this. Oh, let me get it from you. So what is the answer? Contingent, guarantees, crystallization. What is the answer? Off balance sheet. It is D. All of the above. Correct. All of them are the off balance sheet items. None of them is of the on balance sheet items. What is off balance sheet item? Off balance sheet item means here I don't pay cash right now. Right now I don't pay cash. That is off balance sheet. Balance sheet item means what? There I pay the cash. CC term loan, I'm paying the cash. Guarantees, I'm not paying the cash. Okay. Which of the following statements is correct? Now I want the correct one. Okay, correct. You should always mark what is required in the exam. Correct or non-correct. True or false. Whatever. Okay. The funding risk may arise from the need to replace the net outflows due to unanticipated withdrawals of the deposits. So Net outflows, whatever outflows are there due to unanticipated withdrawals, everyone is coming for withdrawal. So you'll definitely face the funding risk. There won't be any money, right? If everyone comes for withdrawal. So is this correct? Yes, A is correct. What about B? Now I want to answer from your side now. Time risk arises when the performing assets turns into NPA. Is this true? Time risk, what is time risk? Let me explain you, but I won't be answering this now, whether B is correct or not. That is what you should answer. Time risk means what? It's a part of liquidity risk. Here in liquidity risk, I don't get money on time to pay for my liabilities. That is time risk. Now tell me whether this B is right or not. When asset turns into NPA, means my performing asset becomes NPA, then I won't be getting the interest, whatever that asset was going to give me, loan was going to give me. So that's why it is again 2. So if 2 are correct, obviously this answer will be D. Let's see the third one also. Call risk arises due to crystallization of contingent liability. Just now we saw. Crystallization of contingent means what? If I give the guarantee on behalf of somebody and that person does not perform. So in that case, what happens? If that person does not perform, then I'll have to pay for the losses of that third party, isn't it? So when I have to pay for this, this is called as crystallization, and this is known as call risk. Okay. So third is also true. Okay. This is also true. So the answer is all of these. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you'll be getting number 1, free YT series on all the subjects, and number 2, latest updates from CAIIB regarding the exams. They give various notifications. This timing change, that timing change, this portion added, that portion added, something, everything. Okay. The features of interest rate risk are interest rate risk. What is interest rate risk? Interest rate risk means the interest rates may go up or down depending on what the RBI is doing or whatever this foreign situations are, means world situations are. So that is interest rate risk. It is an exposure of banks' financial condition to adverse movements in the interest rates. Financial condition to adverse movements. Here, adverse movement means against your will, means against your wish, you can call it. Okay. So it is it that? Yes, it is that. What about the other one? Second one you give me. It has no effect on net interest margin. It has no effect on NIM, net interest margin. I know many of you have typed this answer D now. D. I am seeing D answer. All of these. But remember, all of these, D is, we generally have the tendency of marking all of these, none of these, either A or B. We have the tendency of marking them as an answer, but it's not always correct. Okay. So here B, it has no effect. That is wrong. It has an effect. Interest rate risk will definitely affect my NIM. It may not affect the market value of the equity. That is also wrong. Market value of the equity means whatever is my stock price. If I'm facing an interest rate risk, immediately the stock market grasps it and knows it that yes, I'm facing the problem. Immediately my stock price is affected. So answer is only A over here. Okay, only A. Which of the following is not a mismatch risk? Mismatch. What is the mismatch? Mismatch means assets and liabilities mismatch. Okay, not. We want not, but not a mismatch. Always focus on what is required in the exam. Okay, holding assets and liabilities with different maturities and amount. Is it not a mismatch risk? Liabilities I'm having for 3 years, assets I'm having for 1 year. Is it not a mismatch? Yes, it is a mismatch. So I want not a mismatch. This answer is true. I want a false answer. This is. What is my requirement? F. This is my true. T. Adverse movement in the interest rates. So is it not a mismatch? Adverse movement. Yeah. See this. Let me see the answer from your side. What is C? When the liability is repriced on maturity date and this causes variation in the interest rate. So what is this? Firstly, tell me about B. adverse movement in the interest rate risk. Is it not a mismatch or is it a mismatch? It is a mismatch. Why? Because adverse movement in the interest rate risk will definitely affect me. For let's say same case, asset for 1 year, liabilities for 3 years. If the interest rate moves in adverse directions, it will definitely affect my asset and liability positions or my net profit over here. What about the C? When liability is repriced on the maturity date, this causes variation in the interest rates. So, when liability is repriced, see, this is known as repricing, reinvestment risk, repricing risk. So, this is not a part of mismatch. This is false. This is a reinvestment risk. Okay. How to join the Officers Adda 24/7 YouTube channel? Either YouTube or you can join the LinkedIn using this blue. Scan this QR code right now. Scan this black QR code right now for YouTube. This blue one for LinkedIn. This third one for this Instagram. Join immediately. We are giving various free YouTube series, various questions, various tests freely on that. What is the yield curve risk? Yield curve. Yield curve means it is yield. What is the yield? Yield means basically what are the returns I am getting from the bond. Formula is very simple. Coupon upon price, right? Into 100. Of course, everything is into 100 only. So this is yield. What is the yield curve risk? When I plot this yield for various maturities, here this is time. Okay, various maturities I plotted. So if I plot it for various maturities, okay, then the various the curve which I get is known as the yield curve. So when two different instruments maturing at different time horizon for price, assets and liabilities, so that is basically yield curve risk. So A is right. There may not be parallel movement in the interest rates of both the instruments. Means let's say this is 3 months bond and this is 10 years bond. So both of them will move differently. So that is also true. So once you get A and B as true, the answer will be all of these. Okay. So look at the third one also. Non-parallel movement in the yield curve may affect the net interest income, obviously. And net interest income will be affected if 3 months moves faster and 10 years move slower. So it will be definitely affected, isn't it? So that is again a yield curve risk. Got it, everyone? So what is the yield curve risk? Everyone has got this?
Hi friends, welcome to the Scholar series of BFM. Here we are covering important theory questions, objective questions and some numericals. So let's start without wasting the time.
First question. The liquidity risk of the bank arises from. So liquidity risk of the bank, of any bank. Liquidity means what? What do you mean by liquidity risk? It means that I don't have money at right time. That is very important. At right time, whenever I have to pay my EMI, I don't have money. That is a liquidity risk. Same thing about the banks also. Bank has to pay some bond holder. Okay. At that time, bank doesn't have the money. That is a liquidity risk. If some depositor comes for withdrawal, bank doesn't have money. That is a liquidity risk. So this liquidity risk of the bank arises from number one, funding of long-term assets by short-term liabilities. Long-term assets by short-term liabilities. What do you mean by this word? Suppose let's consider all these cases. Okay, let's consider all these cases. Let's say this is deposits. Here liabilities means deposits, assets means loans. Okay, now case number A, funding of long-term assets by short-term liabilities means what? I'm having a deposit of 1 year and I'm giving a loan of 3 years. Will this create a liquidity risk for me? Just type yes or no over here. Huh? Let's see later. B1. Funding of short-term assets by long-term liabilities. So deposit of 3 years and loan of 1 year. Will it create a problem for me? Funding of long-term liabilities by short-term assets. C. Funding of long-term, this is ab initio wrong. This is from start only wrong. Why? Liabilities funded by assets. Is it possible? Not at all possible. Assets are always funded by long-term liabilities. Means long-term or short-term. Assets are funded by the liabilities. So C is ab initio right, wrong. Okay, ab initio means from the start itself. We need not even discuss this. That is the point. Now the question lies between A and B. Between A, 1 year deposit I am having and 3 years loan I have given. So will it create a problem for me? Yes, it will create. Why? Because this guy who has deposited, this person will come to me after 1 year, but this person will pay to me after 3 years. So this will be a problem to me. What about B? If this person has given me a deposit of 3 years, this guy will come after 3 years, isn't it? This guy will come after 3 years, but this guy will pay me immediately after 1 year. So I won't have any liquidity problem over here because whenever this person comes, I can repay him back, him or her. Okay. So the answer is A. Funding of long-term assets by short-term liabilities. This is a basic logic behind which, based on which this question is dependent. And such questions are asked to in exam. Remember. Okay. Move on. Funding liquidity risk is defined as funding liquidity. Remember this. Funding means I don't have funds. Liquidity risk, but related to funds. So that is defined as excess of liabilities over assets. Excess of long-term liabilities over long-term assets. Excess of short-term liabilities over short-term assets. Inability to obtain funds to meet the cash flow obligations. Very simple definition. Excess of long-term liabilities or long-term assets. Is this a liquidity risk? Excess of liabilities means more of deposits, less of loans. Obviously, that can be the answer. Similarly, B can also be the answer. Look at this. All the answers seem to be right. All of them. You check this. All of them seem to be right. Liability is greater than assets here. I'll show you over here. Liabilities greater than asset. In all the cases, logic is same. Okay. Liabilities are greater than assets here. Over here, excess liabilities over assets. Here, long term over long term. But after all, the same liabilities and assets. Short term over short term. Logic is same. Liabilities over assets. So logic is liabilities are more than assets. So definitely that is the answer. Whenever I have deposits of let's say 100 rupees, okay, and loans of let's say 70 rupees, okay, so will it be a problem for me as a bank? As a bank, do I have a problem in this case? Okay, just check your bank's ratios, your bank's loans and asset deposit ratios. Is it always 100? Let's say this is 100, this is also 100. Is it always 100? No. RBI has given the term as your liabilities and assets should always be 70%. So this is right. Okay, assets will always be lesser than your liabilities. Always. Means basically loans will always be lesser than your deposits. Of course, the ratio is matched so that the rate of interest NII is not affected much. So the correct answer is this: inability to obtain funds to meet the cash flow obligation. That is the correct answer. Okay. So funding liquidity risk is defined as inability to obtain funds to meet the cash flow obligations. Okay. Liquidity risk in banks manifests in different dimensions. Which are these? What do you mean by this? Manifest means comes. It comes in various ways. Okay. It comes in various ways. Dimensions means ways. Let's keep words simple, isn't it? So liquidity risk in bank comes in different ways. What are these? Funding risk arises from the need to replace net outflow withdrawal and non-renewal of deposits. It can be. Just answer. Think over it and answer. Fine. So here, CIB is not like JIB. Just you got the answer, tick it. No. Here you have to think. Funding risk arises from the need to replace net outflows. Non-renewal of deposits means whatever is going out that needs to be replaced. Suppose if tomorrow there is a huge withdrawal from your bank, run on the bank, we call it run on the bank, right? Anyone knows run on the bank? What is run on the bank? Type in the comment section. Okay, just type, do you know run on the bank concept? Type yes or no. Only that much type it. Yes or no. Yes or no. Only that much. Don't give me run on the bank definition. It's a big definition. Yeah. Yes, yes, yes. No, no, no. Yeah. Some no's I am seeing. See here. Run on the bank means when all the customers of your bank, remember whatever I am saying, when all the customers of the bank come for withdrawal of deposits, all of them. So that is known as run on the bank. There's some negative news in the newspaper, something wrong about your bank. So everyone comes for withdrawal. That is run on the bank. So coming back to the question, withdrawal, outflows, withdrawal. So we need to replace these withdrawals through fresh funds. So liquidity risk may arise from this also. Number two, time risk arises from the need to compensate for non-receipt of funds, NPAs. Means basically, suppose if I've given a loan, so what is my logic? The logic says that that person will pay me the EMI, and or CC if given that person will pay me the interest, and that interest I'll use it for paying to the depositors. But if I don't get that interest, don't get that EMI, then what? So that will also create a time risk. Time risk means what? At the time, I'm not having the funds. Call risk arises due to crystallization of contingent liabilities. So call risk arises from crystallization of contingent liabilities. Contingent means what? Contingent means which was not to come, or future transactions, future, like bank guarantee, LC. Okay, these are all contingent. So it comes in which of these cases? Both A and B. Okay, I'll mark it like this: A, B, and C. That is the best answer. So the answer is actually this: A, B, and C. Because funding risk is to replace the net outflows. That is also correct. Time risk is for compensating the non-receipt of fund. That is also correct. And call risk is also a type of this liquidity risk only. Because if tomorrow there is a huge bank guarantee to be paid by you, then from where will you get the funds? Urgent funds. Okay. So both, not both, actually it's A, B, and C. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates from IIBF on JIB and CIB. Means what is updates from IIBF? IIBF gives various notifications. Like now it's exam time, so it will give certain notification that this exam time changed, that exam time changed, this subject's portion is this, something has been added over here, something like this they'll give. So these notifications are explained on this channel immediately. Officers Adda 24/7. Also, you get free YouTube series. Here, right now, what are you watching? You're watching the same free YouTube series. So you get a free YouTube series on the channel for all the subjects of JIB and CIB. All. Okay. So that's why subscribe to it. Click on the bell icon. Click on the like button. Share it with your friends. Okay. When an asset maturing where an asset is maturing in 2 years, the liability risk will be. Suppose if any asset means loan is maturing in 2 years. Okay. 2 years means what? I have given a loan and that guy or girl will be paying me after 2 years. Okay. So what is the liability risk? Now look at this liability risk. Means what risk will I face from the depositor's angle? Basis risk, yield curve risk, gap risk, embedded option risk. From the depositor side, I'll face this risk, depositors, embedded option, right? See here, if this asset is maturing in 2 years, means there is a loan. Let's look at it this way, loan, okay? If this loan is maturing in 2 years, this deposit, I may face a deposit. Here, I have to fund this loan by this 2 years. So what I have to fund is, I have to see to it that I have sufficient deposits for this loan. But if these deposits get matured, FD gets matured, there's a withdrawal, then will I get the same FD of the same amount afterwards? If after the withdrawal, will I get the FD of the same amount at the same rate? That is known as embedded option risk. Embedded means what? Anytime it can withdraw. Suppose if I need this 1 lakh rupees over here and this 1 lakh is withdrawn from here, depositor's angle, then my balance sheet is in a problem. So embedded option risk means there is a chance of withdrawal of FDs, withdrawal of savings deposits Plus, there is a chance of repayment of these loans also. Now, this is from the loan side. Somebody repays these loans. So, embedded option risk is for both the sides, loan also and deposit also. Here we are talking of liability, deposit side. So, that's why it's the main embedded option risk. The risk of adverse variance of mark to market of change in the market price of the interest rate instruments, equities, is called. So, mark to market. What is mark to market? Mark to market means that basically the logic behind mark to market is, suppose if I brought let's say a bond, and that bond I am not going to sell immediately, but mark to market means what, whether if what is notionally I am gaining some profit or not in that. That's the meaning of mark to market. Suppose if let's say you have brought a flat, you have purchased a flat, okay, for staying flat you have purchased. Now this flat you won't be selling it now because you are staying in that. But you get the daily rates for this. There are certain brokers who come to you, sir, the flat right now you had brought it at let's say 30 lakhs. Now the flat is giving you around 50 lakhs. So this is what this difference is known as notional or mark to market. Notional or other name is mark to market, M to M. Okay, M to M means what is the rate at which I had brought and what is the present value of my security. Okay. So risk of adverse variance of mark to market value of change in market price in the interest rate instruments is called as price risk, market risk, translation risk, both A and B. What is the answer? Let me get it from you now. I'll explain you, not an issue. But let me get it from you first. It is both A and B. Price risk and market risk, both. Because here, market price risk is actually a part of market risk. And price risk arises because of the interest rates. If the interest rates go up, interest goes up, interest rate goes up, then the price of the bond will go down. Price will always go down. Price. Okay. So this is basically the logic behind this. Which of the following is not a market risk? Not. Okay, not a market risk. Compliance, transaction, legal, all of the above. Let me think. Type fast in the comment section. Which of the following is not a market risk? Not. Market risk means what? What is a market risk? Market risk means that risk which is not in your hands. Not in your hands. Okay, keep it very simple language. Okay, not in your hands. Russia-Ukraine war, not in your hands. Then the COVID situation, not in your hands. Right? RBI changing the repo rates, not in your hands. So this is all market risk. So which of the following is not a market risk? So compliance risk. Compliance means what? Submitting the returns or submitting the consent documents to RBI. It's in your hands. You have to follow the compliance. So it is not in your hand, right? Not a market risk. So it is, I'll write it not a market risk. N. Transaction risk. Transaction means whatever transaction I'm doing, I must maintain precautions in that. So there's no market risk. External forces are not acting on this. Legal, again, it's a part of this transaction risk only, right? Means basically operations risk. These are all operations related risks. So this is not a market risk. Answer is all of the above. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CIB, we get it over here. So that's why download it right now, immediately, and start studying. Don't just download it and keep it. You have many apps in your mobile. Okay, just tell me, everyone, how many total number of apps you have in your mobile? How many? If you don't even know the numbers, even I don't know. How many of these apps have you watched? Do you watch regularly? I know you watch only WhatsApp regularly, only WhatsApp, tick 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 tick, and some other one or two more. Nothing else. Okay. Somebody might be watching that shopping apps, Amazon and all those things. That's okay. But remaining apps, we just download it and keep it. Don't just download it, use it. Go through it. What are you getting? You are getting many free features over here. Of course, paid classes are there, but free features also, free tests you are getting, free books you are getting, free classes you are getting. So download it and start studying. Okay. Country risk is an example of market, credit, operations, and liquidity risk. So country risk is an example of what? It is a part of credit risk. See here, credit risk always is of two types. Always remember this, two types. Okay. One is country and second is counterparty. I'll just write it. Okay, full only I'll write it. Counterparty. Because many of the students might not understand this. Short form of this is actually CP. Okay. But counterparty risk. So country risk and counterparty risk. Credit risk always has two parts. Okay. All of the following are types of price risk except, now again we want except means not, which is not the type of price risk. So all of the following are the types of price risk except commodity price, exchange rate, stock price, counterparty risk. Just now I gave you. What is the answer? Just now. Yeah. Type fast. Just now I gave you. Yeah. This one. Look at this. Credit risk is a has two parts: credit and counterpart, country and counterparty. So counterparty will be a part of what? Will it be a part of price risk? No, it is a part of credit risk. So this is credit risk. This is not the one. This is yes, this is yes, this is yes. All these are price risks. But this is a part of credit risk. Okay. In financial market, bond prices and yields are JIB. JIB studies. Okay. Bond prices and yields are inversely related, directly related, inversely or directly depending on the type of the bond, and none of these. JIB. Okay. Give me the answer. Yes, it is. What? What is the answer? Bond prices and yields. Inversely, right? If the yields go up, what is yield? Yield means asking rate. If the asking rate of any bond goes up, the price of that bond will go down.
Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering the important theory, numericals, objective questions, case studies. So follow the series till the end and also follow complete series, all the lectures, same time, same channel, Officers Adda 24/7 YouTube channel. Okay? Press on the like button, share it with your friends. Okay? So let's start the session. First one. These are all the objective questions which come in your exam. So a person wants to make an investment of 50,000 in one of the following for 5 years. Now suppose, let's say you want to make an investment of 50,000 in one of these for 5 years. Out of this, which one should be preferred solely on the basis of risk if the return is 10% in all the cases? So return is same now in all of them. Basis of risk only. FDR issued by an NBFC, a bank FDR, a long-term government security. All are equal since the return is same. So what should I place yourself in the place of this person? What will you choose? FDR issued by NBFC or bank FDR or a long-term government security? See here, important point, return is same 10% in all the cases. Even this NBFC is giving 10%, FDR bank is giving 10%, government is giving 10%. Or is it that all are equal? So the answer can be C or D. What do you think should be the answer? See here, we are asked to choose solely on the basis of risk. Which one is having the lowest risk? Government security, right? A long-term government security will be chosen. Why? Because it is having the zero risk. That is called as sovereign. Any country's government is called as a sovereign government. Okay, democratic government is called as a sovereign government. So the security on this democratic government is always, or sovereign government is always with highest security, and the risk is zero. Okay, so I'll be choosing this C. Which of the following is correct statement? Lower the risk premium. Lower the risk, higher the risk premium. Higher the risk, higher the lower the risk premium. Lower the risk, no risk premium. What is the answer? Lower the risk, low is the risk premium. Is it so? Suppose if the risk is low, then the risk premium will be lower or higher? What do you think? If the risk is low, what do you think? The risk premium should be lower or higher? Let me see how many of you can answer this. Yeah. This is a basic question for your BFM. So the answer is correct. Only A. Lower the risk, lower is the risk premium. See, our logic is very simple. Low risk, I'll write it over here. Risk, no, here I'll write it because here I'm having a lot of space. Risk. And second is premium. Premium means what? Premium means the charge. Premium. What do you mean by this charge? I'll give you a simple case. Okay. Let me ask you, insurance. Insurance for age of 20 years and insurance for the age of 60 years. Where the risk is higher? Suppose if a person is having 20 years age or somebody is having 60 years age, where the risk is higher? So here the risk is low, right? And here the risk is high. So look logically also, this insurance premium for these two persons, insurance company will charge lowest premium for this person, lowest. And for the 60-year person, firstly it won't give any insurance. No insurance, right? It won't give any insurance. But if it gives, somebody insists, okay, that no, I want the insurance at any cost. In that case, the premium charge will be too high. Too high. Okay. So that is the case. Low risk, low premium. High risk, high premium. That is the basic logic, isn't it? Management of risk within the bank is to be the major concern of. So management of risk in the bank is a major concern of whom? Top management, senior management, middle management, and operational management. Major concerns here. Management of risk is actually the job of everyone, right? So obviously it is the job of everyone. The one who is working in the bank needs to manage the risk at his or her desk or his or her whatever that department is, right? But this question relates to something else. This question relates to major concern means who is here. Importantly remember, as you go higher in any bank or any company, mainly let's say bank only. As you go higher in any bank, the work divides like it's like this. How does the work divide? See here, responsibility is on the top. Responsibility, okay, that is on the top. And at the bottom, transactions means working, practical working, transaction. So if I am at the bottom level, I am at the lower level now, working over here. So my transaction will be higher over here, right? And responsibility will be less. It won't be zero. Otherwise somebody will say zero. It's not zero. So it goes like this. As I move above the transaction to the responsibility level, my responsibility goes on increasing. Okay. So my responsibility over here will go on increasing like this, and transactions will go on decreasing. So at the responsibility level or at the top level, my responsibility top, this is top. At the top level, my responsibility is highest. Okay. But this is for top level. Top. You can write it here also, top level. And this is for the bottom level. Okay. So as I go higher, my responsibility goes on increasing, but my transactions go on decreasing. Okay. So my transaction level will go on decreasing and responsibility will go on increasing. So now again coming back to this question, management of risk within the bank is a major concern of, basically remember, it's a major concern of top management. Okay. Why top management? Because they are only concerned with the responsibility part. Does the top management do any transactions over here in any bank? No. right? So it is a major concern of theirs. Management of risk begins with mitigation of the risk, identification of the risk, controlling the risk, and quantification of the risk. See here, in the paid classes, I have taken in details about this class, and again we are having one more paid batch coming up for BFM. Join this immediately, because there I have taken the complete process of risk management. Always remember, first it is identification of the risk. Okay, identification. Once you identify, then you quantify it. Quantify, that is step number 2. Step number 1. There are total 4 to 5 steps in this. Then control, mitigation, right? So management of risk begins with what? Just now I have told you, identification of the risk. Step number 1. You have to first identify the risk, whether the risk exists or no. That you have to know first, isn't it? Usually the risk management organization in the bank consists of board of directors, risk committee, risk management committee to board, senior level executives committee, risk management support group, and all of the above. So what does it consist of? Okay, let me explain. Again, I'll tell you, join the paid classes immediately. Okay, if you don't know this answer, join the paid classes immediately. There we have taken it almost 3 to 4 times, this same topic. So firstly, always remember, in a bank, the main concerned party is board of directors, top level. They are the concerned persons for anything which happens in the bank. Below them works RMCB, risk management committee to board. Okay, RMCB. Below them works the senior level executives committee. Senior level executives committee. Okay. Now this senior level executives committee consists of senior level. I won't write the full form now. Full thing. Okay. In this senior level executive committee, there are 3 committees. Okay. One is ALCO. Second is CRMC. And last one is ORMC. Okay. Now what is the ALCO? ALCO is for management of the market risk. CRMC is for the credit risk. ORMC is for the operations risk. And below this, then works the support group. So support group will always support these. Support. That's why the name is support groups. Okay. So this is the sequence. Board of directors, risk management committee, senior levels, and this support group. So what is the framework then? The framework is all of the above. Okay, all of the above is the answer. Got it, everyone? Clear the concept? This concept should be very clear in your mind. Okay, shall we move on to the next one? Okay, next question. Which of the following has the responsibility for implementation of risk and business policies simultaneously in a consistent manner and decide on the business strategy to achieve these objectives within the bank? Question is a difficult one. Okay, so which of these following has the responsibility of, it's a two-edged sword, you can call it. Okay, what are the 2 edges? Implementation of risk and business policies over here. Okay, that is point number 1. And second, simultaneously in a consistent manner. So both risk and business policies. So if you want to contain this, go to the lowest risk, business will be affected, right? And if you want to get the highest business, risk will be affected. So that's why it's called as a 2-edged sword. Okay, so simultaneously in a consistent manner and decide on the business strategy to achieve these objectives. So who has this? Board of directors, risk management committee to board, senior level executive committee, and risk management support group. Who has the responsibility of implementation? Okay, implementation is the job of which level person? Is it of the board of directors, or is it of this RMCB, or is it of the senior level? Yeah, think over it. It is everyone. Yes, it is. Remember, board of directors formulate the policy, formulate the policies. Okay, board of directors do formulate the policies. Then RMCB is the committee working below the board of directors. It gives them the suggestions. Okay, and number two, whatever board of directors think over it, think of various risk factors. Its job is to penetrate it to the lowest level. But the implementation part is lies at the executive level, that is senior level executive committee. Senior level executive committee has the job of implementation. All these in this senior level executive committee, you have all the three. What? ALCO, CRMC, okay. ALCO, CRMC and ORMC, right? CRMC, ORMC. Okay. So these three committees together have the job of implementation. Okay. All the transactions undertaken by the bank have one or more of the following risks. So all the transactions, all. Now you are talking of all means it is related to cash clearing transfer, account opening, loans, any type of loans, forex, anything you call it under the roof of banking. Market risk including liquidity and interest rate risk, credit risk including default risk, operational risk, and any of the above. Think over it. Let me see in the comment section what are the answers. Yeah. Now it depends. See this. Suppose if you are dealing in forex or securities trading, then here you'll be having forex. Okay, forex. I'll give you simple examples. Forex. Then you will be having the market risk. Suppose if you are dealing with loans, you will be having the credit risk. Suppose if you are dealing in any of these now, loans, forex, or even the liabilities, deposits, then you will be having mainly this operations risk, right? So all these transactions are a part of banking transaction. So your answer will be any of the above. All the banking transactions shall have one or more of the following risks. That is, either it can have market risk or credit risk or operations. Now see here, I've given here the word as forex. It doesn't mean this market risk is only related to forex. I've given here credit risk for loans. So it doesn't mean only for loans. Credit risk is for loans as well as others, means for securities also. Operational risk can be for loans, deposits, forex, any transaction, treasury. Okay. A bank branch sanctioned a term loan of rupees 10 lakh for a period of 7 years at 3 plus base rate of 9% of the bank. The funding of the loan, let's cancel this, 3 plus base rate. Okay. The funding of the loan is from a 3-year deposit at 7%. Which of the following risk this transaction is associated with? So 10 lakhs is sanctioned, okay, as a loan. It is for 7 years at 3% plus base rate. So what is the base rate? Base rate means nowadays here, let's change this from base rate to repo rate now, because nowadays we use repo rate. So 3% plus repo rate. Now funding is from 3-year deposit at 7%. So my loan is for, now look at it, loan is for loan and this is deposit. Okay. My loan is for 10 years, 10 lakh 7 years. Okay, 10 lakh and 7 years. My deposit is for, the amount is not given, so it is same 10 lakh and it is 3 years. Now this loan rate is what? Loan rate is base rate plus means repo plus 3, R repo plus 3, and this is 7%, this is fixed. Now the bank is facing what? This amount is same, but what about this year, 10 year? So it will face this funding risk, time risk, liquidity risk, all of the above. Look at the question properly. Okay. Let's tackle one by one. Now the deposit is for 3 years, loan is for 7 years. So after 3 years, the person who has deposited the money will come back for the funds. So that time you won't be having the money because it is given for 7 years. So you will be facing what? Liquidity risk. Right? Similarly, this funding risk. Why funding risk? Now funding risk means how to obtain the money. So this after 3 years you will be facing this funding risk also. Now what the time risk? Time risk also you will be facing because after all the durations are different. Similarly for this repo plus 3 and 7, here also you will be facing the funding risk. So funding risk will be affected over here because of this time also and because of this rate also. Because if the repo rate tomorrow decreases or increases, then your bank will be in a problem depending on whether it's above 7 or below 7. Okay. So all of the above is the answer. The bank will be faced with all the types of risks. Okay. Funding, time, liquidity, all of them. A bank branch sanctioned a term loan of 10 lakhs for a period of 7 years at 3%. Is it the same question? No. No. 3% plus base rate. Let's consider this repo again of the bank. Okay. The funding of the loan is from 3-year deposits here. Basic question remains the same. Only the risks are changed. So the bank will be faced with what? Again go back to this. Okay. So I'll just copy this and write it over here. Loan and that deposit, right? I think so. The amount is same. 10 lakh, 10 lakh. Here it is 7 years, here it is 3 years, and now here it is repo R plus 3 and it is 7, right? So now what are the risks the bank is facing? Basis risk, operational risk, reputational risk, and all of the above. Again, many of you are in typing this as all of the above. Many of you are typing this all of the above because we are in the habit of typing all of the above. We feel that basis, operation, everything is there. But remember, in this case, operational risk is inherent to each and every transaction of the bank. It is inherent here. Operational risk will be there in your savings, current, FD, loan, treasury, trade finance, everywhere it will be there. So don't consider that. Reputational risk is separate. If something comes in the newspaper on any web portal about your bank, bad, and that affects the bank's overall stature, then it's called as a reputational risk. Here you will be faced with basis risk. Okay. What is basis risk? Change in the rate of interest for the loans and deposits in different magnitudes. Now in this case, if you consider deposit rate is not changing at all, it is 7%. But the loan rate is changing, repo plus 3. So repo can be anything. Okay. Repo plus 3. So that's why you will be faced with Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering important theory, numericals, objective questions, case studies. So follow the series till the end. Okay? And follow the complete series. All the lectures. Same time, same channel, Officers Adda 24/7 every day. Various numericals are taken, various objective questions are taken. Share it with your friends. Okay? So let's start. The market risk arises on account of transactions reflecting in banking book, trading book, banking and trading book. So what is the answer over here? Banking book, trading book, banking and trading book. Banking book, trading book, off balance sheet exposures, anything. What do you think should be the answer over here? Market risk. Market risk arises because of trading book. Remember, trading book. Got it? when the rating of a financial instrument is lowered by the rating agency, the spread over the risk-free rate. Now what happened? This is a bit tricky one. Okay, understand, there are two parts to this question. First is when the rating of the financial instrument is lowered. Okay, now who are the rating agencies? Let's say simple, let's take it CRISIL. CRISIL is a rating agency. Okay, now imagine CRISIL, what does it do? It reduces or lowers the rating of this any company, let's say. Okay, let's say example, I'll say only X. Why to name anyone, isn't it? Let's say X company. So CRISIL reduces the spread this what rating of this X. Now the spread over the risk-free rate, will what will happen to this? Now if the rating is reduced, now you tell me. I'll ask you a simple question. See here, BFM is about understanding. Suppose if you are an investor and I'll tell you that, see, my rating has been reduced by CRISIL. Now you please give me the money. I'm issuing the bonds. What will you ask? What will you tell me? I was earlier giving the bonds when my rating was AAA. Let's say my rating was AAA, then I was giving the bonds at, let's say, 6% per year, per annum. Okay, I was issuing the bonds and you are taking it. Now my rating has been reduced to, let's say, B. Reduced. Now I again come to you, kindly buy my bonds. So what will you say? I'll buy a bonds, but the rate of interest required on this will be, now because your rating is reduced, I'll be requiring 9% now. This will be your requirement, right? You will ask me, right? You will ask me this. So this will be your asking rate. So what will happen? So if your base rate is, let's say, repo rate is, let's say it is 6%. So earlier that spread was what? 6 minus 6, 0. Spread was 0 over here. Now the rating has been reduced. So now 9 minus 6, your spread is increased. Spread equals to 3%, right? So it is increased. So what will be the answer over here then? Increases as the market demands higher yield on the higher risk on a higher risk instrument. Decreases as the market expects lower yield on the higher risk instrument. Remains constant, and there is no relationship. Now just now, as I gave you. See here, firstly, have you understood this? Because my rating is reduced, so people will demand from me the higher rate of interest, isn't it? So definitely as the rate of interest increases, my spread increases. What is the spread? Spread is the difference between the rate which you pay versus your base benchmark rate. So 6%. How do you calculate the spread in your normal savings account? Spread. How do you calculate the spread in normal banking account? Let's say any banks. We calculate the loan interest minus deposit interest, right? So if my loan interest is, let's say, 9%, deposit interest is, let's say, 6%, then what do I say? My spread is 3%. Okay, so this becomes my benchmark rate. Every spread there is a benchmark rate. Benchmark. In this case, in our case, what is given? This benchmark is the repo rate. So it can be anything. Huh? Benchmark means on which I base my further calculations. Got it? Clear? The process of market risk management has the following parts: risk identification, risk measurement, risk monitoring and control, risk mitigation, and risk pricing. So what all do they have? Market risk management. What will it have? Is it 1 to 5 all, or is it 1 to 4 only? Is it 1 to 5 all, or is it 1 to 4 only? Yeah. Oh, okay, I'll give you a hint over here. Now the answer is between B and A only. C and D are out, let's say. B and A. Either it's 1 to 5 all, risk identification, measurement, monitoring, mitigation, and pricing, or only 1 to 4. This pricing is not there. Type in the comment section. Let me see. This is a bit tricky one. Huh? Okay. So remember, shall I give you the answer? Yeah. It is this B. 1 to 4 only. Remember, market risk management. Market risk management. Okay. Market risk. What is the market risk? Market risk is that risk which is external to us. External. It is not in your hands. External to us. It is not in your hands. Okay. So that is market risk. Now, if this is a market risk, what have you to do? You have to manage it. Manage it means you can't zeroize it. You can never make this risk zero. So risk identification is a part, measurement, monitoring and mitigation, but pricing is separate. Pricing is always based on what is the level of my risk. So this is separate from the management part. Okay. So the answer is B, 1 to 4 only. That is the answer. 1 to 4 only. Got it? The market risk management policy formulated by the board of directors of a bank generally takes into account, means this market risk management. What did I say about market risk? It is external, not in your hands. There are three types of risks. What are the three types of risk? Credit, market, and ops, right? At least in your the CAIIB you have these three types of risks and Basel 2. Okay, and if you consider Basel 3, then you have systemic risk as the next risk. Okay, so now this market risk management policy formulated by a board of directors. Here there is an important hint over here. Formulated by board of directors. Here any policy is formulated by board of directors. Now what are the parameters it takes into account? On what basis does this board decide? Market risk management policies, market risk management procedures, aggregate risk limits, risk review mechanism, and reporting and audit systems. What is the answer? Now many of you have got afraid that 1 to 5 may not be there, right? So the answer over here is A, 1 to 5 all. Okay, here the answer is all. Market risk management policies, the policies which are earlier decided by the bank. Now we are formulating a new policy, right? So here you are following market risk management new policy. So earlier policies, what did it say? Earlier history policies before this year. Procedures, what are the procedures followed in the bank? Limits. Now risk limits are of various types. Always remember, aggregate risk limits, there are various types. They are starting from the deal size limit to the per day limit to this per dealer limit to this aggregate risk limit. Review risk review mechanism. So that is obviously the review should always be there, and reporting and auditing system. So all of the five will be taken into account. Okay. Which of the following is not a part of the role of the ALCO in a market risk management? Here, the three committees which are very important are, one is ALCO, then CRMC, then ORMC. These are the three committees which are very important. These are the executive level committees. Okay. More on these committees I've explained to you in yesterday's lecture, I think so. Yesterday or day before yesterday. Follow that. ALCO, CRMC and ORMC. ALCO manages mainly market risk. Mainly. CRMC mainly manages credit risk. And its ORMC manages ops risk. Okay. So, which of the following is not a part of the role of the ALCO in market risk management? Think over it. What is the answer? See, here, these types of questions are asked in exam. They are not that simple. Okay. What do you think should be the answer over here? See, here, let's see the options. Product pricing of deposits and advances. Setting up guidelines for market risk management and reporting. Funding policy and transfer pricing. And balance sheet management. Yeah. What do you think should be the answer over here? The answer is, shall I give you? See this, the answer is this, B. Setting guidelines for market risk management and reporting. Here, setting guidelines is not the part of ALCO. Okay. Now let me explain. I have explained you in earlier lectures also, but remember, the hierarchy is like this. First one is Board of Directors, BOD. Below this comes RMCB, Risk Management Committee to Board. RMCB, Risk Management Committee to Board. Below this comes Senior Executives Committee. Okay. Now this Senior Executives Committee is of three types. Okay. ALCO, CRMC, and ORMC. Below this, there is the group called as support group. Always remember, see, this is the overall hierarchy. Support group. Okay. Now, one thing you remember, this is executives committee. So here their job is implementation. Implement. They are not there to prepare the guidelines. Guidelines are prepared over here. Preparing is done over here. Okay. So product pricing of this advances, we want not the job. Huh? So product pricing is the job of ALCO. Funding policy and transfer pricing. This is the main job of ALCO. Transfer pricing. Okay. Balance sheet management. This is also a job of ALCO. What is transfer pricing? Transfer pricing means the rate at which the loan is transferred within the departments. Tricky. Within the departments means what? It means that suppose if I am having let's say I am a retail department. Retail means I am having the retail loans of housing loans. Okay. I am having the retail housing loans. Now I want to sell these loans to my treasury department. My treasury department. Okay. I want to sell these loans to my treasury department. So at what rate should I sell? So that is decided by the transfer pricing. Okay. And that is decided by the ALCO. Got it? Which of the following is not a correct statement regarding sensitivity in context of the market risk measurement? Sensitivity. Which of them is not a correct statement? Not. Okay. Now sensitivity. Now sensitivity is itself a big topic. Sensitivity measurement is itself a big topic again. Sensitivity is measured using this duration approach and BPV approach. This can't be explained over here right now. That's why I'm saying join the paid classes. New batch is starting. Join fast. Okay, I'll tell you at the end. So, sensitivity is measured at as a change in the market value due to the unit change in the variable. We want not correct. Huh? Measured as a change in the market value due to the unit change. Unit change in the variable. In the variable means generally it is repo rate. Repo. It can be any benchmark rate, any. But this is a basic definition of sensitivity. Change in the market value of that bond or anything, any commodity, based on the unit change in the benchmark rate. So this is true. But we want false. Sensitivity as a measure suffers from the fact that it does not consider impact of other parameters which may also change simultaneously. So is this B true? Think over it. Yeah. Remember, this sensitivity measurement is done using correlation. Correlation means this will always measure two factors at a time. Only two factors. Two factors at a time. Okay, so it will measure only two factors. That's why this statement is also correct. Suffers from the fact that it does not consider impact of other parameters, which may also change simultaneously. So these two factors only are considered. These two factors, let's say this example A only. Change in, let's say, the price of the bond versus the repo rate. So only two factors. It does not consider inflation. It does not consider any war-like situation happening. So these factors are not considered. So that is also true. Sensitivity as a measure suffers from the fact that it does not remain constant for all the values of the variable. Does not remain constant. That is also true. For all the values of the, as the variables change, the sensitivity will go on changing. Okay, you take the simple example of this duration only, modified duration. As the rate of interest goes on increasing, y goes on increasing, the modified duration goes on decreasing. See here, if the r goes on increasing, modified duration will go on decreasing. You must know the basics of this modified duration now. Okay, in this case, are you able to see this? Yeah, so modified duration will go on decreasing over here. Okay, so that's why this is also true. So what is the formula for modified duration? Modified duration equals to Macaulay's duration, Mac upon 1 plus r, right? So as this r will go on increasing, this modified duration will go on decreasing. So the correct answer is D, none of the above, because we want a false answer. Okay, so the correct answer is D over here. Got it? Next one. The change in value due to 0.01% change in the market yield is called as 0.01% change in the market yield is called as basis point change, percentage change, duration, or price volatility. Think over it, everyone. Yeah. Okay. The answer is basis point. See here, there are two things. Okay. That's why I said sensitivity. It is measured in two ways. It is measured in two ways. Okay. One is BPV and second one is duration. Okay. Duration approach is the change for 1% of your repo rate. BPV is the change of 0.01%. So this is known as BPV. 0.01% is called as BPV. Percentage change, duration, price volatility. This duration is not correct answer. Many of you have typed this as duration. This is for 1%. Volatility is totally different. Volatility means standard deviation. Okay, got it? Next one. On average, the equivalent time which the holder of the bond must wait to receive the present value of the cash flow is called as downside potential, duration, basis point valuation, and value at risk. What is this question actually? See this. Understand, for this you need to understand the Macaulay duration. Here we are talking of Macaulay duration. There are two durations. Okay, Macaulay and modified. Okay, what is Macaulay duration? The rate at which, or the number of years of the bond in which the interest rate risk or interest rate fluctuations, fluctuation, one and the same thing, is zeroized. Okay, and modified means percentage change in the price of the bond depending on 1% change in the repo rate or any base rate. Okay, So now, when the holder of the bond must receive the present value of the cash flow, present value. Whenever you want the present value, you have to take this duration approach. That is Macaulay duration. Okay. Always remember, Macaulay duration will give you that value or that period for which you need to keep the bond, so that present value cash flow, whatever the present value of the cash flow is, right now what is my rate of cash flow, the same should be received throughout the life, that Macaulay duration. Okay. So always remember, definition of Macaulay duration is interest rate risk or fluctuation is zeroized. Got it? Last one. The longer the duration of the security, which of the following statement is correct? So longer the duration of the security, shorter will be the price sensitivity yield charge, and higher would be the risk associated with the bond. Greater will be the price sensitivity and higher would be the risk associated. Greater will be the price sensitivity and associated. Shorter will be the price sensitivity and lower will be. See this, the whole game is between shorter, higher, greater, higher. This is the only game. You have to decide between these. What do you think? In fact, rather than what do you think, what you know, that's important. Thinking is not. Thinking means you can think anything, A, B, C, D. Question is what you know. Do you know the answer? See, the answer is very simple. You have studied this in your JAIIB. JAIIB. Okay. What have you studied? As the duration of the bond or period of the bond, period. There were total 11 theorems. Remember this? 9 or 10 theorems, I think so. Yeah. They are there for the bond valuations. What were those theorems? As the period goes on increasing, okay, the sensitivity or the changes, okay, price sensitivity you can call it. So sensitivity will go on increasing. That was one of the theorem. Goes on increasing means there will be more fluctuations in the bond of the longer duration versus the bond of the shorter duration. Means, one more I'll give you an example. Suppose if I'm having two bonds, A and B. Okay. The period for one bond is 3 years. The other bond is, let's say, 30 years. Okay. Now the rate of interest, let's say repo rate. Repo is today, repo. Let's say the repo is 6%. Now tomorrow this repo goes to, from 6 it goes to, let's say, 7%. So 1% increase. Who will be affected more? So this bond B will be affected more. Affected. Okay. Here it will be affected less. And this will be affected more. Okay. Why? Because as the duration of the bond increases, life of the bond increases, the effect of the sensitivity or change in these repo rates is higher. So greater will be the price sensitivity and higher will be the risk associated with the bond. Okay, so the answer is B. Got it? Now before going, everyone join this AIM batch. All the numericals, objective questions, case studies covered over here. Strictly as per your books. It is starting on 22nd March. So fresh batch. You have nothing to lose in this up till now. Nothing is lost, right? Fresh batch is starting. Join it immediately. Plus you can join the Mahapack 2.0. In Mahapack you are getting multiple batches per subject. Okay. So how to join this? Let me show you. Go to Adda 24/7. Click on JIB and CIB. I'll always suggest you to go through the app. Okay, through the app. Click on CIB. Now you'll see this AIM batch. Click on this AIM batch. Okay. Now, if you see this AIM batch, you will find this, that all the ebooks, test series, online live classes, live recorded classes, experienced faculties, recorded sessions, all these are available. And look at the discount part. Click on buy now. Okay. Once you click on buy now, you'll see this. Let me bring it Let me bring this easier. Hold on. Yeah, now it's okay, right? So once you click on continue, put the code Y432, Y432. Click on apply. Look at this, 80% off you are getting. Plus, if you are using the app, you are getting 81% off, one extra. Okay. If you join the Mahapack, in Mahapack you are getting multiple batches. Okay, multiple batches. Let's see. See this. CAIIB Mahapack 2.0. So you are getting multiple batches over here. In this, you are getting double validity right now. Multiple batches means you are getting around 7 to 8 batches per subject. Now the offer is going on. Double validity means you buy for 6 months, you get 6 months free. Okay, see this 6 plus 6. You buy for 6 months, you get 6 months free. Plus this 80% off, 81% off. Y432. Never forget this code Y432. Click on apply. See this 80% off you are getting plus 1% on the app. So join it immediately. Okay. I'll be back tomorrow with another series. Till then, keep studying and do join the batches. Okay.